In today's video, we are going to look at a case study where an individual has a lump sum of money. They're interested in putting that lump sum of money into a whole life insurance policy. We're going to consider a MEC. So when you hear the word MEC, typically what do you think of with respect to whole life insurance? Well, a MEC is a modified endowment contract, and if your policy becomes a MEC, what happens is you've got taxation on the cash value. How it works specifically is the cash value grows tax deferred, and if you ever decide to access your cash value, whether you withdraw money or you take a loan, you're going to have to pay ordinary income tax on the gains. So any money greater than what you paid in will be taxable to you as ordinary income. And if you're under the age of 59 and a half, you've got to pay a potential 10% penalty tax. Sound like a good deal? No. Almost every policy we set up is typically a non-MEC. However, there are cases where a MEC can make sense. It really depends on the individual's goals. And in today's video, we're going to look at a case where a MEC might make sense. It depends on really how the individual answers a specific question, which I'm going to ask very shortly. Let's look at some details first, though. So we have an individual who is 68 years old. She recently received a lump sum of about $500,000. How that money was received was a life insurance benefit. So she received this money income tax free and is looking at what to do with it presently. So what we're looking at is a whole life insurance policy, and we're looking at two things here. Usually we look at one thing. If you've watched any of our content, you know we always aim to maximize the cash value. That's really the focus of about everyone we work with. In this particular case, however, we're looking at maximizing the cash value and maximizing the death benefit. There's an important word missing from here, which would be long-term. So we're looking to maximize the long-term death benefit. You'll see exactly what I mean when we look at the numbers here. So here's the big question. Do you want access to the cash value? Not, do you need access to the cash value? Not, do you think you might want to access it? Is, do you want access to the cash value? Is there even a 1% chance that you feel you may want to access this cash value? Because if that's the case, we probably do not want to go the direction of a modified endowment contract, because we're going to have to deal with taxes and such. And a lot of times people prefer not to have to deal with that at all, especially if we're in a higher income tax bracket. So answers to the question. If you answer yes, I'm going to want access to the cash value, or even I think I might want to access it. If I answered it like that, or someone answered it in that manner, I would say, okay, we probably want to look at a non-MEC policy here. If it is a clear no, I've got other assets, I'm very concerned about leaving a long-term death benefit, I still want to see the cash value grow just in case I cash the policy out or whatever, I just want to see it there, it makes me comfortable, but I probably won't use it, or I'm almost certain I won't use it. That's where a MEC can make sense. This is very similar to how banks use cash value life insurance. When you look at banks, they own bank-owned life insurance. It's a single deposit. They just add a lump sum into a life insurance policy. They've got a positive cash value immediately, a large death benefit, and it just appreciates over time. They see positive growth. They rarely access the money because it is a MEC, and they don't really have any desire to access it either. So a MEC policy for an individual would be very, very similar to what banks do. Just write a check for a one-time lump sum, let it sit and grow. The death benefit is still paid out income tax-free. So let's look at the strategies here. First, we'll look at a non-MEC. So we've got two options with respect to funding the policy for the non-MEC. With a non-MEC, it is not efficient at all to write a check just for 500 grand, send a lump sum into my policy. That won't look attractive. We've got videos that go through how to fund a policy with a lump sum. We would not want to do that. What we would do for someone 68 years old, a female age 68, is take that 500K and break it up over 4 policy years. So that's 4 years at $125,000 per year, because 125,000 times 4 gives you a total of $500,000. So that's option A. However, if she said, I don't really want to gradually fund it, can I just write a check to the insurance company and be done with it? It's very common to see individuals with a lump sum of money want to do that. They just want to get it all done with and then have the funding taken care of. The answer is yes, you can accomplish this with a non-MEC policy. What we would use is a premium deposit account. Not all life insurance companies have these, most do. So what this involves is writing a one-time check for $500,000, sending it to the insurance company. Specifically, we're depositing it into their premium deposit account. This will be the same insurance company that we're taking out our whole life insurance policy with. So we write a check for $500,000. What happens then is the insurance company is going to hold the $500K and move the money into the life insurance policy over 4 years. What is moved into the policy is the $125,000. That's the principal, call it, plus interest. In this example, we'll see the interest come out to $8,370, and that's per year for 4 years. So we're getting interest while the money is sitting with the insurance company. So what this comes out to is a net of $133,000 and change per year for 4 years that's being moved from the deposit account into the life insurance policy. So now the total dollar amount that has been moved into her life insurance policy is how much? $533,000 and change, which, how some people look at this is, all right, I just got an extra $33,000 and change into my policy, which is now compounding, which is sweet. That is the case. However, one thing that's very important to be aware of is that that is taxable. So the money in the premium deposit account, when it is moved from the deposit account to the life insurance policy, the interest each year is taxable to you as ordinary income. So how that works is you'll receive a 1099 from the insurance company for whatever the taxable amount is. You'll typically see a report from the insurance company that'll give you an estimate. Of course, you want to work with your accountant or CPA to get an exact number. None of this video is tax advice, but as the deposit account moves money into the life insurance policy, the interest is taxable to you as ordinary income. So you will pay some tax on the interest there from that deposit account. So we're going to look at that. What we'll compare it to, though, is this, a MEC policy. This is very simple to follow. And why I say that is what we've got here is just a one-time lump sum of $500K, and we're just going to send it right into the life insurance policy. Because we're not concerned about a MEC. We don't need to have a large death benefit. We don't need to have a term rider, nothing fancy like what we would normally do to prevent a MEC. So when we look at the two options here, some questions may come up, especially if you're new to cash value life insurance and such, with a non-MEC, which why people are interested in this is because it means you can access your cash value tax-free, provided we don't trigger a MEC or do anything else that could trigger a taxable event. I would check out our video above that goes through whole life insurance and taxes for information on that. But this is why people want the non-MEC policy. I can access the cash value tax-free. Okay. Another name for our MEC limit. So every life insurance policy has a MEC limit, which is exactly what it sounds like. It's a limit that determines the maximum dollar amount you can fund your policy with per year and have it classified as a life insurance policy, not a MEC. If you fund your policy with more than whatever that MEC limit is, guess what happens? Your policy becomes a MEC. Here's the thing about the MEC limit. This is the fun part. You can set it wherever you want. What you'll find is that it has a direct relationship to the total death benefit on your life insurance policy. Your age and the product you pick will impact this as well. But what you'll see for the non-MEC policy is we've got funding of how much? You're going to see $133,000 and change per year going into the policy. So let me know if what I'm about to say describes your situation. I'm interested in a whole life insurance policy. I'm interested in it because of the cash value, And the death benefit, I don't really care about that right now. Maybe I will long term, or maybe I am concerned about it, but I really want to make sure my cash value is maximized, meaning I don't want to sacrifice cash value growth to capture a high death benefit or anything like that. If that sounds like you, what we would do when setting up a policy, something like this. If this is the dollar amount going into the policy per year, so we're never going to pay more into the policy than that $130,000 and change figure. What I want to solve when I design this policy is what is the minimum amount of life insurance needed to give me a MEC limit of that dollar amount, $133,370, right? We might solve it so the MEC limit's $135 or something like that. My point is minimize the death benefit as much as we can so the IRS still views the life insurance policy as life insurance. Now, with that said, if we don't care about that and we say, hey, I'm good for MEC because I'm not going to access the cash value anyway, then we're just going to make a huge deposit. We'll have a low death benefit, but we don't care because we're not concerned about the MEC, and then we'll watch it grow over time. This is going to have a higher long-term death benefit as well, and I'll explain why when we look at the numbers, and we'll look at them right now. All right. So let's begin with our non-MEC policy here. We'll begin with what we have here in purple, our premium deposit account. So here we're assuming we write a check to the insurance company for $500K. And then what the insurance company is going to do is over the next 4 years, they're going to move money from that deposit account to the life insurance policy. And with the interest earned, comes out to $133,000 and change per year. So the total outlay, or I should really say total input as far as money going into the policy, is how much? $533,000 and change. When's the break-even point? Depends how you look at it. Because how much did you actually send to the insurance company? $500K. When do you have more than $500K? Year 4. So one could argue that the break-even point is year 4, looking at your true out-of-pocket. But if we look at the actual payments made to the life insurance policy, falls between years 5 and 6. What I mean when I say that, let's take a look at the illustration. Also what I like to refer to as stereo instructions. Got a lot going on here. So when we look at the actual life insurance illustration from the company, here's your funding for 4 years. There's your cash value. There's your death benefit, 1.21. But the funding each year, look at the column immediately to the right. Cumulative net after-tax outlay. There you go. So following the life insurance illustration, the break-even point falls between years 5 and 6. But in any event, cash value is juiced. We maximize the policy as much as we could with this 10-pay policy by minimizing the base premium and maximizing the PUA rider. This is one product. This illustration is with Guardian. This is the one product where we can only illustrate an additional 5x the base premium. Or with other products, it can actually go up to 10x the base premium in PUAs. That's how you really optimize the cash value. But if you've seen some of our content, normally in a case like this, that premium is going to be closer to $12,000 or $13,000. Anyway, back to the Excel workbook. So here we go. You've got the funding, death benefit. Kind of an oddball number when we look at it, isn't it? $1,210,000. Why would we set it at that? I know that annoys some people. Just when we see an oddball number, it's like, hey, just make it a clean 1.2. Could we make it a clean 1.2? No, not in this example. Because the $1.21 million gives us a MEC limit of, guess what? $133,370. $370. It's slightly higher than that. But if we made it $1,200,000, $10,000 less, the funding there would actually be under the MEC limit, and this policy would become a MEC, or you'd have to pay a lesser dollar amount in. So that's where we came up with that oddball death benefit. We solved for the absolute minimum in order to maximize the cash value. So again, this is a non-MEC, and here we're assuming this individual wants to access the cash value, or they think they might want to access it. Most people do, because I see it grow and I can access it like a personal line of credit for other opportunities. A lot of times we see people who will typically purchase real estate in cash, use a policy as an alternative because they don't have to go to a bank and finance the property. They can do it with their policy and finance it, especially if I have a low cost to borrow, or this policy is a fixed rate, 4.76%, 5% fixed if I don't pay the interest annually. Anyway, that's some extra info. Let's compare it to the MEC policy. So now I don't care about accessing the cash value. What do you notice here? What's your initial death benefit? $729,000. What happens here? Goes up, comes down a little bit in year 4, and that's just based on a trigger I pulled in the software to minimize it. Could actually minimize it a little bit earlier, but here, there's not much of a drop there. Yeah, it dipped a little bit because I'm just trying to get every penny I can out of it. But aside from that small drop, what do you see as time passes? Death benefit goes up. What happened with a non-MEC policy? Death benefit drops after year 7. Sometimes this question comes up, why does it drop? Going back to the non-MEC policy, the reason why is because after the first 7 years is the earliest we can drop the death benefit without triggering a MEC or a modified endowment contract. So we just reduced it as early as possible. With the MEC policy, we're not concerned about that. And it's already at the minimum from the get-go. So what happens here? Well, it just keeps on increasing. And we see that it gets pretty attractive as time passes. What's your cash value look like? Very attractive up front. You're at 90%. You paid in $500,000. You've got $451,000. Now, if you accessed this $451,000 day 1 or anytime in the first year, would you have to pay taxes? No, you would not, because there's not a gain on the policy yet. Where taxes occur with MEC policies is once a taxable gain exists. Now, what I'll also say is if you take a loan against a MEC policy, when there's not a gain, and then a gain exists in the future, remember you're earning interest on the non-borrowed and borrowed cash value. If a gain exists in the future, that loan interest could be taxable to you as ordinary income. It's interesting when you look at the details of modified endowment contracts. But main thing I wanted to mention is early years, if you did want to access the cash value before there is a gain, because there's no gain, there would be no taxes. It's after there's a gain. But cash value is attractive up front. Break-even point between years 3 and 4. There you go. And it just keeps on appreciating. Pretty nice. So this is nice because I do see my balance grow over time. If someone received an inheritance, like this particular case, she got $500K. She's in a low tax bracket and said, hey, I got this from a life insurance policy. I'm just going to put it in here. If I need to access it, that's perfectly fine because I'm in a low tax bracket anyway. It's not going to be a big concern for me. I like seeing it grow like this. That might be an example of where someone chooses a MEC. But again, in a case like this, we're going to talk through it with them and make sure we really get the decision right. Because if once we start a MEC policy, you're locked in. Like we can't make it a non-MEC. But looks good when we look at the values long-term. Continues to appreciate, doesn't it? So there is a level of attraction here, but really this is usually the reason why, because that death benefit is treated the same as it is with a non-MEC. It's paid out income tax-free. So as I get to mortality, my expiration date between age 85 and 90, here's your death benefit. Is it higher or lower than the non-MEC? Let's do this. It's higher, by 85. So you've got more life insurance that has passed. And if we scroll down, we'll see the gap continue to widen. So that could be a case of where we would consider a MEC. We've got the difference in values right here, actually, cash value difference and death benefit difference. Once we drop the death benefit with a non-MEC, that's where the MEC is going to take over and continues to pull ahead. Good example to look at, just to wrap this video up, most people we work with do select non-MEC policies because you've got access to the cash value. And when you look at it long-term, the difference is not drastic, especially in a case like this. However, where the MEC would make sense is if the individual was certain that they do not need access to the cash value, and the death benefit, while it's lower up front, if they're comfortable with that, they're looking at the long-term benefit, and they like the appreciation of the cash value, just more of that emotional feel. I'm seeing it grow. If I'm in a low tax bracket, I can access it without as much of a concern of the tax situation with the MEC. So I hope that this was helpful. If you have any questions, please do let us know in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.